Purpose of this webinar is that the impact that our choices have on society and the environment, I suppose they've never been greater than what it is today. Everything we do, from the food we buy to the way we travel, has a consequence on ourselves and the world around us. As well as adjusting our lifestyles, changing the way we invest our money is one way to help change the way businesses behave. So investors can collectively push an industry in the right direction by investing in companies that are taking action and avoiding those with harmful practices. Now, Rowan Dartington of the Discretionary Fund Management and Stockbroking Division of St James's Place, the organisation that Navigation Wealth Management chooses to use for its clients' investment vehicles. Now, Dominic Smith is a member of the Chartered Institute for Securities and Investment, and he's also the Rowan Dartington investment consultant, looking after St James's Place businesses like Navigation Wealth Management and their clients in the north of England. And Dominic has 30 years UK and international investment advisory experience. So Dominic's very well versed to be able to talk to you about the importance of responsible investing. So without further ado, Dominic, I'll hand over to you. Thank you.
Thanks very much. Thank you all for attending. I'm not sure how many we've got this evening, but I hope it's a healthy number and that you're all at home, safe and well. As Matt mentioned, I've got over 30 years experience in investment advisory. I'm also the father of 3 children, 23, a 21 and a 19-year-old. And I'm constantly being challenged on what it is I do for a living. Am I doing the right thing? And what type of planet am I going to be leaving behind for my children? So this is an area that I'm very passionate about. And as I say, I'm keen to help with you to show what we can do to help. Start with a quote from Tim Cockrell. Tim's the investment director at Rowan Dartington, and he looks after our responsible investing portfolio and proposition. And he highlights there that ESG is about connecting the abstract world of investments to the reality of the real world and to the impact it has, good or bad. It's about the connected nature of all things in the world, from ecosystems and our climate to poverty and prosperity and to social injustice. And through investment, seek to change these. So why should we all be considering how we invest and how we can invest responsibly? This slide shows what's been happening to the planet in the last 60 years. The second half of the 20th century has been unique. If we look at population on the top left there, we can see the steep increase in the past 50 years. Indeed, I'm 54. And I read data recently that the world's population has doubled in my lifetime. So significant increase there. We've also seen a massive increase in GDP. Urban population is skyrocketed. We've got a population right now that's increasing in cities by 1.5 million people per week in the emerging economies. If we look at the energy use, again, a significant uptick there since 1960. Increased transport, as we can see, significant there. Fertilizer consumption, we need to feed the population. So that's gone incredibly high as well. But also what's on the bottom left there, we can see the marked increase in carbon dioxide, nitrous oxide. The surface temperature of the earth increasing considerably there. Coastal nitrogen and tropical forest loss. It's all seen a significant uptick in the past 60 years, and it's not sustainable. If we look at the average annual temperature, it's difficult not to see what impact the human race is having on the planet and the way we live our lives and the way we consume. Ice caps melting, we can see it at an alarming rate. Sea levels increasing, average temperatures increasing. In fact, in the last 15 years, we've had 10 of the hottest years recorded since 1880. More concerning is the CO2 concentration. If we look at the chart on the right there, we can see historical cycles. This goes back 400,000 years. And you can see that the concentration of CO2 in the atmospheres peaks out at normally around 300 parts per million. And these cycles tend to last 1,000 years or so. Frighteningly, if we look at the extreme right-hand side of the table there, you can see the rate of increase from 1950 to today is off the scale. It's gone over to probably more around 400 parts per million, and it's evident the impact that human factors are having. You may have seen slides like this before. It just shows a concept called Earth Overshoot Day. What this refers to is the fact that humanity is using nature 1.6 times faster than the planet's ecosystem can regenerate it. It means by 2050, if we continue to consume at this rate, we'd need 2 planet Earths to support us. And increasingly worrying is if we all lived like Americans and consumed like Americans, we'd actually need 5 planet Earths. So where are we now? Back to sort of 1750s with the Industrial Revolution, we then saw steam and railways develop, heavy engineering, oil automation and mass production, and then IT as industrial revolutions. And now society is making that move towards a low carbon and a sustainable economy. And this we're calling the 6th revolution. With any revolution, there's opportunity. And we look as people move to more electric vehicles, new battery technologies, sustainable food sources, non-meat products, smart metering, etc., as areas where we believe we can invest in the right way, help society heal the damage we've caused to the planet, but also ensure that you're still getting a return from your investments. Again, if we look at the tech stocks that have been coming through and performing extremely well since the downturn. Again, we're looking at where to invest for the future using a range of asset classes. So what is responsible investing? Well, there are 3 elements to it. When I started in the industry, let's say 30 years ago, the only option if you wanted any form of positive investing was the ethical investments. And the amount of areas they could invest in was very limited. Another feature of the ethical style investment was that it was generally thought that if you choose to invest this way, you won't see the same returns as you would in a normal, let's say, FTSE style investment. But ethical is probably the purest form of ESG investing or responsible investing, in that it simply takes out areas like tobacco, alcohol, weapons, any areas that really cause damage to the earth or to society. ESG is a more broad approach. This looks at the environmental, social, and governance policies of the companies you invest in, or of the funds that we invest in as well. And then we look at impact investing. This is exactly companies that have a positive impact or direct impact on social change. So things like wind farms, solar farms, etc. Our approach is to take all 3 aspects into account. So why should we invest responsibly? We'll all have heard of our carbon footprint and how we're trying to reduce it. People are making changes in their lifestyle, the rise of veganism and vegetarianism, non-meat substitutes. We're looking at recycling. We all certainly recycle more now. But interesting, Nordea, a large North European finance company, did a survey, and they analysed people's investments in ESG and non-ESG, and discovered that actually by moving your pension savings into a responsible investment portfolio, you'll increase your impact and reduce carbon footprint by over 27 times. Now, I'm not sure how analytical they were on that, but it does seem to strike home with me. We can make changes. So we talked about becoming shareholders in companies and actually encouraging them to change their way. Our portfolios are made up of an element of them is individual equities. So you will become shareholders in the companies that we're investing in. And shareholders have strength. They can change how companies operate. A good example recently is a mining company called Rio Tinto. They're the second biggest mining company on the planet, but the shareholders have basically made them now stop coal mining. So they've sold off their coal mines. They no longer coal mine. BP, another example, where the company is trying to become carbon neutral by 2050, all highlighted by shareholders and all under pressure from shareholders. Finally, we'll look at investing in the future. We're looking at the companies that are in the top FTSE 100 today. Well, if we go back 20 years, that would look very, very different. And we also believe that if we look forward 20 years, the makeup of the FTSE 100 will be very different. So it's about working with companies that are committed to their ESG principles, also looking at companies that are going to be working with the new technology that comes through and benefit from it. There are four broadly different approaches to responsible investing. There's restriction screening, i.e., putting in specific areas that you don't want to be invested in. So negative screening. I say that's the ethical style of investment, and that's probably the purest form. There's RI, or responsible investment integration, and these are companies that are committed to the United Nations 17 Sustainable Development Goals. We can look at thematic exposure, so responsible consumption, infrastructure, climate action, renewable energy, etc. And we can look at impact investing as well, so companies involved in education, in clean water and sanitisation. At Rowan Dartington, we consider all four with our portfolio construction. So when we come to build portfolios for our clients, we do both negative and positive screening, but we're pragmatic. We try to look at the companies. So where, for example, we negative screen for animal testing, we do allow pharmaceutical companies who provide drugs and medicines to animals to actually test them on them. So it's not a blanket wipeout. We'll certainly not consider companies who manufacture alcohol, but we may consider companies who sell it, so supermarkets, etc. And equally, we'll then apply positive screening. So we do look for companies that may specialize in water management, certainly clean and renewable energy, sustainable transport, resource efficiency, education and environmental services. Each portfolio is built to a client specification, but with all these principles in mind. We take quite a broad approach, as I say, and a pragmatic one. Our goal is to help make a return on your investment. We do what we call bottom-up research, which means we actually sit and we meet with the fund managers if we're using collectives. We meet with the CEOs of companies that we're investing in. We also have an independent third-party research, companies' ESG credentials and individual stocks, etc. And we use all that research before we start putting any investments onto our approved portfolios. We also have top-down allocation, asset allocation and investment committee. So they'll design the structures of the portfolios, the different asset classes involved, etc. And this asset allocation really is where we see the positive returns and also the reduction in risk and volatility as well. So where are the areas and what are the themes that we can invest in? Well, really, they're vast compared to what they were even 10 years ago. We can look at renewable energy. You can see energy efficiency. We can look at design, engineering, and software. We look at sustainable agriculture and forestry, water management, water technology, clean water supply, waste collection, sustainable packaging, circular economy, and pollution control. The portfolios have a diverse allocation across a range of sectors. You can see a typical portfolio on the left there. We'll look at industrials, consumer services, financials, etc., healthcare, utilities. We believe that diversity, again, reduces the volatility, helps manage the risk, but also targets positive returns. If we actually compare a typical ESG investment to a FTSE All-Share, you can see we're actually quite underweight on consumer goods, basic materials, and oil and gas, but overweight on things like technology, telecoms, healthcare, and industrials that we are happy to invest in. Interestingly, in the recent downturn following the COVID crisis, the ESG portfolio didn't reduce anywhere nearly as much as the typical balanced portfolio would, because we didn't have the likes of the oil and gas stocks, and certainly no airlines and things in that side of it. It also recovered more quickly and is actually positive on the year. So the portfolio itself is constructed using direct equities. So if we look at UK companies, we invest directly into those. So you'll become a shareholder in the companies we invest in. As I mentioned, we use a third party called Ethical Screening. We'll filter companies and get their ratings for us, so we get an independent view as well as our in-house one. And we also look at AIM stocks, or alternative investment market stocks. So companies that pass our screening and are up-and-coming companies that we feel have got a strong opportunity to grow and enhance returns. When we look at global equities, fixed income and alternative investments, again, we'll use collectives, so we'll use funds, but we'll use the same principles as we apply to the individual stocks. So to summarize, our responsible investment approach aims to give you a portfolio that's designed firstly to maximize the potential for your financial return, but also to ensure that we're addressing global environmental and social challenges. We take extensive research to find the best funds and equities to do this, continue to monitor them. We continue to look for new opportunities, and we always make sure that the portfolio is managed within your risk tolerance and also to meet your long-term investment goals.